when a single rumor triggered a financial storm. It began with a sentence whispered in the wrong room, just a hint, a suggestion, a quiet claim that something inside one of the world's most trusted institutions wasn't as stable as it appeared. No evidence, no confirmation, just a rumor, small enough to ignore, but powerful enough to ignite the fastest chain reaction the market had seen in years. To understand how this happened, we need to revisit a moment when confidence felt unbreakable. Institutions presented flawless reports. Analysts echoed optimistic forecasts. Investors believed they were protected by reputation alone. It was a time when trust replaced scrutiny, and that is always when danger starts to grow. This story matters now because markets still move on whispers. Prices collapse not only from facts, but from fear. And in a world where information spreads faster than truth, a single rumor can shift billions before anyone verifies a thing. The first reveal begins with the origin of the whisper. A mid-level banker overhearing fragments of a private conversation. He didn't know the context. He didn't know the speaker's intent. But he caught one phrase that froze him in place, just enough to hint at hidden losses deep inside the institution. He didn't spread it maliciously, just cautiously to a colleague, but rumors rarely stay small. The second reveal came when that colleague mentioned it to a friend at another firm, not urgently, not loudly, just in passing, framed as an odd concern. But the financial world is a web of interlinked ears. Soon, the whisper crossed firms and departments, then entire trading floors. Each retelling added a shade of certainty. What began as a fragment slowly transformed into a narrative. The third reveal unfolded when algorithms noticed something before humans did. Subtle reductions in exposure to the institution's debt. Not massive, not obvious, just enough to tilt the balance. Machines flagged the shift as abnormal. Automated models tightened risk parameters. Spreads widened just a little. But in markets built on confidence, just a little is sometimes all it takes for the storm to begin. As the whisper traveled, it mutated. What began as a vague concern became a possibility. A possibility became a suspicion. And suspicion, once it enters the bloodstream of the market, spreads faster than any fact. Traders notice slight changes in behavior. Clients ask quiet questions. Counterparties took a moment longer than usual to confirm routine transactions. Nothing tangible, yet everything hinted at unease. The conflict began when a major fund made a small, seemingly harmless adjustment. They reduced exposure to the institution's short-term debt. Not significantly, not publicly, but enough that insiders noticed. In a stable market, such a shift would have gone unnoticed. But in a market where a whisper was growing louder, it amplified the tension. Other funds followed suit, not out of certainty, but out of caution. And caution, when multiplied, becomes its own narrative. The tension increased when liquidity in one of the institution's key instruments suddenly thinned. Traders who always found buyers now struggled to place even moderate orders. Bid-ask spreads widened. Volumes dropped. Algorithms interpreted this as a sign of risk and automatically reduced exposure further. Machines were not reacting to truth. They were reacting to behavior, and behavior was reacting to fear. Inside the institution, executives sensed the shift, not through public news, but through the sudden change in tone among their partners. Calls that were once casual became formal. Requests for information became urgent. A few large clients quietly moved money elsewhere, not dramatically, but decisively. It was a kind of movement that suggested someone believed the rumor, even if they couldn't prove it. The conflict escalated when a mid-tier bank, long dependent on the institution for short-term funding, adjusted its internal risk model. The effect was instant, a drop in overnight lending, a temporary pause in routine transactions, small signals, but alarming ones. These systems were designed to trigger only when patterns resembled past crises. The institution's leaders held emergency meetings. They combed through balance sheets, verifying that nothing was wrong. Their fundamentals were solid. Their liquidity was intact. But none of it mattered. The rumor had created distortion powerful enough to override facts. Perception, not numbers, now drove the system. Markets reacted with increasing volatility. Analysts speculated quietly. Commentators noticed the widening spreads. Hedge funds, sensing opportunity or danger, no one could say which, hedged aggressively. And every hedge reinforced the illusion that something was wrong. The whisper had transformed. It was no longer a rumor. It was a question the market couldn't answer. And unanswered questions are the foundation of every financial storm. As the pressure built, one more shift was about to push the system over the edge. A move so small that almost no one noticed it, yet powerful enough to accelerate the crisis into its next phase. The shift came from a corner of the market that rarely draws attention: insurance against institutional default. Normally calm, slow, almost sleepy. But suddenly, spreads in that market ticked upward, not dramatically, but consistently. A few basis points here, a few there. Enough for specialists to notice, enough for algorithms to react, and enough for the rumor to find its first concrete echo in the numbers. The cautious uptick triggered automated hedging across multiple funds. Not because anyone believed the institution was failing, but because their models were designed to protect against worst-case scenarios, no matter how irrational. As hedges expanded, liquidity drained even further. Instruments tied to the institution lost depth. Prices slipped, not from fundamentals, but from fear dressed as probability. Inside trading floors across the city, conversations shifted. Traders who had dismissed the rumor now watched their screens with quiet tension. Analysts added a new line to their morning notes: monitor counterparty exposure. A single sentence, but one that carried a warning. Even without confirmation, perception was turning into behavior, and behavior was turning into pressure. The conflict sharpened when a major hedge fund executed a defensive trade large enough to leave fingerprints. They didn't exit their entire position, but they reduced enough to send a message: prepare. Others followed, not to profit, but to avoid being the last to react. Markets do not fear truth. They fear being late. Meanwhile, inside the institution, the leadership team raced to identify the source of the rumor. Internal audits found no irregularities. Liquidity reports came back clean. Capital buffers were more than adequate. Yet despite perfect numbers, their cost of borrowing climbed. Their partners demanded more collateral. Their name, once enough to silence doubt, no longer carried the same weight. Pressure intensified when reporters caught wind of the story. Not the truth, but the movement. A brief article appeared online noting unusual activity around the institution's credit instruments. It didn't accuse, it didn't sensationalize, but the headline alone was enough to shift the narrative from whisper to possibility. Markets reacted instantly. Algorithms widened spreads again. Short sellers tested positions. Clients withdrew small amounts, testing, probing, gauging stability. It wasn't a run, it was a rehearsal. And rehearsals are often precursors to storms. Inside the institution, panic whispered through hallways in ways public statements never reveal. Phone calls increased. Executives canceled travel. Risk committees convened hourly. Each new chart showed the same pattern. Confidence weakening not because of data, but because of the absence of certainty. The rumor had become self-sustaining. The buildup reached its peak when a regional bank, spooked by the growing tension, quietly refused to roll over a routine funding agreement. It was a tiny event, lost in the noise of global markets. Yet it marked a turning point. Funding wasn't collapsing, but it was hesitating. And hesitation, multiplied across thousands of transactions, becomes instability. In that moment, the institution realized a truth no one wanted to admit. The storm was no longer about the rumor. It was about the reaction. And the reaction was accelerating. The acceleration hit suddenly, not through a collapse, not through a headline, but through a cascade of small decisions made at the same time by people who didn't know they were acting together. A handful of funds tightened limits. A few banks demanded slightly more collateral. Several clients withdrew moderate amounts just to be safe. None of these actions were dramatic on their own, but collectively, they signaled a shift the institution could feel in its core. The leadership responded with urgency. They released statements affirming stability. They opened their books to partners. They reassured regulators, clients, lenders, anyone willing to listen. But reassurance struggles to compete with fear, especially once fear believes it is evidence. And every minute the rumor remained unaddressed. It grew sharper, heavier, more believable. Then the spark ignited. A major financial news outlet published a short report suggesting heightened counterparty concerns surrounding the institution. It didn't blame them. It didn't accuse them. It simply reflected the market's behavior. Yet the moment the article went live, the rumor transformed into narrative. Narrative became pressure. Pressure became reality. The institution's borrowing costs spiked in real time. Liquidity evaporated in crucial markets. Algorithms triggered defensive moves across global exchanges. Hedge funds piled into protective positions. Short sellers, sensing opportunity, amplified the momentum. It was a chain reaction the institution had no time to stop. Inside the headquarters, the crisis peaked. Emergency meetings blurred into each other. Transaction lines froze. Foreign partners hesitated. What had begun as a whisper now roared like a storm. Executives watched numbers they knew were solid become irrelevant under the weight of market psychology. Facts had lost the battle. Perception had taken command. The climax came when the institution issued a public statement late in the evening, revealing they were working with regulators to ensure market stability. It was meant to calm the world, but to markets wired for fear, it confirmed the suspicion they had built out of shadows. Overnight, global exchanges reacted violently. Futures fell. Spreads widened. Investors fled anything connected to the institution. By sunrise, the store was complete. The institution had not failed. It had not collapsed, but had been forced into emergency measures simply to survive a rumor that never carried proof. And the world finally saw how fragile trust truly is, how confidence can vanish faster than truth can travel. The resolution arrived slowly, over days. Audits cleared the institution. Reports confirmed its stability. Regulators assured the public that nothing had been wrong in the first place. But none of that mattered. The message left behind was the true legacy of the storm. Markets do not move on certainty. They move on perception. And when perception breaks, even the strongest foundations tremble. Sometimes all it takes to change the course of a market is a whisper. Sometimes all it takes to steady it again is a new understanding of how quickly we can be led astray. Sometimes the moment we choose to pause, question, and breathe becomes a first step toward clarity.